Have you ever pondered the magnitude and complexity of picking stocks in the bustling marketplace of Wall Street? This crucial process, often shrouded in mystery and financial jargon, might seem like an intricate ballet of fluctuating numbers, rising and dipping trends, and economic forecasts. The sheer volume of information can seem overwhelming, creating an invisible barrier between you and this world of potential financial growth. It's easy for the uninitiated to feel daunted, and perhaps even intimidated by the labyrinthine process. But fear not, it's not as unnerving as it seems. Delve a little deeper, and you'll uncover that the art of stock picking is just like any other skill. It time, patience, and a keen understanding of both the broader economy and specific industries. Like a master chess player, you must anticipate moves, calculate risks, and make decisions based on a complex array of factors. First and foremost, it's crucial to understand your investment goals, which serve as your compass in this expansive financial wilderness. Are you in it for the long haul, hoping for steady growth over the years? Are you aiming to build a nest egg for retirement, or perhaps to fund child's education? Or are you an adrenaline junkie, seeking the thrill of short-term wins and willing to take on higher risks for potentially higher returns? Each investor is different, with unique goals, risk tolerance, and investment horizons. It's essential to define your individual investor profile before jumping into the fray. This understanding forms the backbone of your investment strategy, guiding your decisions and helping you choose stocks that align with your specific goals. Remember, the stock market isn't a game of chance. It's a strategic endeavor that, when approached with discipline, research, and a clear plan, can yield significant rewards. Knowing your investment style gives you a roadmap, guiding your decisions and helping you choose stocks that align with your goals. Next, you immerse yourself in company research. It's about looking beyond the simple ticker symbol, the unique set of letters a company uses for stock market identification. It's about delving deep into the company's core, its fundamentals. These are the factors that set the stage for a company's financial health and growth potential. Consider the company's earnings, an important metric which tells you how much the company makes. Have a look at their profits, the bottom line that shows if the company is making more money than it's spending. Explore their debt levels. Knowing how much debt has and how well it's managing, it can tell you a lot about its financial well-being. Ask yourself, is the company actually making money? Are they efficiently managing their debts? How are they performing compared to their peers in the industry? A company that is financially healthy, that exhibits prudent fiscal management and solid earnings, often makes for a robust investment. However, it's crucial to remember that these numbers only tell half the story. They paint a picture of the company's past and present, but not necessarily its future. To fill in the rest of the image, you have to look at the industry the company operates in. Ask yourself, is it a growing industry or is it on the decline? Does the company have a competitive edge that sets it apart from its competitors? What are the industry trends, and how is this company adapting to meet them? A company that can harness change, and to its advantage, will be primed to grow and succeed. In a world that is constantly evolving, with new technologies and markets emerging every day, it certainly pays to invest in companies that not only have the ability to adapt, but also the vision to thrive in whatever future the business landscape holds. Now, you might be wondering, how do I find all this information? This is where we introduce financial statements and annual reports. These reports, when properly understood and analyzed, can act as powerful tools in your investment decision-making process. Essentially, they serve as a company's report card, providing an in-depth view of its performance and potential. Financial statements include a balance sheet that reflects the company's assets, liabilities, and shareholders' equity at a specific point in time. It's like a snapshot of the company's financial strength and capabilities. Think of it as a company's selfie that shows its financial appearance at a specific moment. Then there's the income statement, which showcases a company's revenues and expenses over a specified period. This statement helps you understand how profitable a company is currently and potential profitability in the near future. Further, the cash flow statement tells you how changes in balance sheet accounts and income will affect the cash. It gives a detailed picture of how a company generates and uses cash to support its operations and fund new investments. Annual reports, on the other hand, provide a comprehensive overview of a company's activities throughout the preceding year. They offer a detailed narrative of the company's operational, financial, and business performance. These reports often include the CEO's letter to shareholders, discussing the company's performance and sharing future aspirations. Moreover, these documents often include market analysis, future outlook, and investment plans. They can assist you in understanding the industry's competitive landscape, the company's positioning within it, and its future growth potential. In summary, Financial statements and annual reports are rich sources of data that provide a profound understanding of a company's health. These documents can equip you with the necessary knowledge to make informed investment decisions. So when you ask, how do I find all this information? Your answer lies in these essential documents. Enter financial statements and annual reports. These documents are a treasure trove of data, offering deep insights into a company's health and prospects. And then there's the price-to-earnings ratio, also known as the PE ratio. Now, this isn't just a string of numbers and symbols. It's a crucial tool that gives an investor insight into the market value of a stock. This handy little metric is one of many we can use to help us determine if we're looking at a potential gold mine or if we're about to step into a financial quagmire. The PE ratio is a reflection of the market's beliefs about the future of a company. A high PE ratio could suggest that the market expects high earnings growth in the future. Conversely, it could also indicate that the stock is overvalued and that its price is higher than what the earnings justify. It's a bit like seeing a luxury car with a hefty price tag. You want to if you're paying for the brand, the performance, or if you're simply paying more than it's worth. On the other hand, a low PE ratio might seem like a bargain, like spotting a designer dress on a clearance rack. But much like the dress, you can't just look at the price. You have to consider the quality, the design, and the demand. A low PE ratio could indicate that a company's earnings are expected to decrease, or that the market has undervalued the stock. It could be a signal of a potentially great investment opportunity, or a warning sign of ship. What's key, however, is to avoid looking at the PE ratio in isolation. It's not a magic number that can tell you everything you need to know about a stock. It's just one tool in an investor's toolbox. For a truly insightful analysis, the PE ratio should be compared with other financial metrics and ratios within the same industry. This allows for a more accurate and meaningful perspective when evaluating a company's financial health and future prospects. However, it's essential to compare the PE ratios within the same industry to get a meaningful perspective. Don't forget about dividends. They are a significant part of a business's financial structure and can offer considerable benefits. You can think of dividends as the monetary rewards that a company chooses to distribute to its owners, the shareholders. They represent a fraction of the company's earnings, which are, in essence, profits made by the company after all its expenses and taxes have been paid. This distribution of profits is not done haphazardly. The board of directors of a company decides whether to pay dividends and then how much to distribute. The amount can vary greatly depending on several factors, including the company's profit margin, its financial needs for upcoming projects or expansions, and the overall economic climate. Dividends can be given out annually, semi-annually, quarterly, or even monthly, depending on the company's dividend policy. When you invest in a company's stocks, you aren't just betting on the company's future success or hoping that the stock's price will rise. You are, in fact, buying a piece of the company. As such, you are entitled to a share of the profits that the company makes. These are your dividends. Now, you might wonder, why are dividends so important? They are a source of predictable, regular income that does not depend on market conditions. This means even during economic downturns or when the stock price falls, you could still be receiving dividends. Therefore, they can act as a safety net, providing you with a steady income stream. Furthermore, companies with a long history of paying dividends are often mature, stable, and financially healthy. This is because paying consistent dividends requires a reliable cash flow. Hence, these businesses are less likely to go bankrupt and can weather financial storms. So if you're looking for a reliable income source, companies known for their substantial and consistent dividends can be an excellent choice. They are often seen as less risky and can provide a sense of financial security. If you're looking for a steady income, companies with a history of paying out healthy dividends might be an attractive option. Finally, keep an eye on the market trends. The stock market, much like the ocean, is influenced by many external factors. Being aware of these trends and waves can help you ride them to success. In summary, stock selection is a process that begins with understanding your investment goals. It involves deep diving into a company's fundamentals, considering the industry it operates in, analyzing financial statements, and assessing the PE ratio. It also involves considering dividends and staying aware of market trends. So, the next time you're about to dive into the stock market, remember these steps. They'll serve as your guiding light, leading you through the labyrinth of numbers and trends to your investment goals. Stock selection might seem like a complex dance, but with these steps, you'll be waltzing through it with grace and confidence.